Hello and welcome to my channel, The Quality Investor. Investing can be intimidating, especially when just beginning. It's very tough to hit that buy button and send your money out into the ether. Safety is comforting. If you don't buy, you don't lose, but you don't gain either. Many strategies exist though to try and mitigate that risk so that we only gain but never lose. We all want that steady income, that assurance that we'll gain something even if the bears rule the market. However, you can earn some passive income without that pressing fear of loss. Problem there is the rate of return is so small and sometimes the capital won't even appreciate. These of course are things like treasury bills, savings accounts, bonds, money market funds. But today we're talking about the best form of passive income, not something legally classified as passive like real estate, but actual passive income. We're talking about dividends. But before we dive into the world of dividends, if you enjoy content like this, please hit that like button and subscribe to the channel. It really helps this channel grow and lets me know that you want to see more content just like this. Also, remember to share this video and hit that notification bell so you can know right away when I post more stock analysis content. Today, I want to talk about how not all dividends are created equally. You see, when we buy a stock for its dividends, we want certain assurances. It is literally income, so we do not want that to go away. So we must know that dividend is reliable. And just like we want raises at work, we want raises in our dividend income. Not just any raise will do. Our dividends must increase faster than our arch nemesis, inflation. So this video will be all about how to study that dividend and making sure that we're getting a safe, reliable, and growing dividend. But I also want to talk about what kind of traps to avoid, what signs there are that a company might cut that dividend. A dividend cut is seldom a good thing. And if we're relying on that dividend for income, it can really hurt us. So we must make sure to carefully and thoughtfully select our dividend stocks. I see 4 important factors when considering a dividend. The first is growth. Is the business increasing their dividend annually and by how much? Secondly is reliability. How many consecutive years has the business not just paid their dividend, but increased the dividend? Third, we have yield. Yield is like Goldilocks. You don't want it too high, but you don't want it too low either. It has to be just right. A high yield can be a trap, and low yield requires huge upfront capital. And finally, we have payout ratio, but not earnings payout ratio like the mainstream tends to focus on, but free cash flow payout ratio. So I'm going to show examples of each of these so you can visualize these parameters. It's important to understand what good growth looks like, how to interpret yield when it's trending upwards, and what sort of signs does a business show when its dividend is in trouble. Let's get right into it. The first business I have here is 3M, ticker MMM. 3M is a dividend aristocrat, and this is an example of what slow growth looks like. Just a couple red flags here. First, you see in the visual itself, you see it plateaus over time. Sort of quick growth, and then it suddenly flattens out. And when we look at the compound annual growth rates, we see on a 10, 15, and 20-year basis that it increased faster than inflation. However, in the last 5 years, it's slowed down quite a bit. This is coupled, of course, with some other indicators, such as a growing yield, a rising free cash flow payout. So when you're seeing growth like this is the first sign of trouble. Contrast that now with another dividend aristocrat, Lowe's Companies, ticker LOW. Here, this encapsulates what very nice, healthy growth looks like. It has an almost exponential feel to it. You can see it just going faster over time. And when you come up to the compound annual growth rates, you can see that's always been very healthy growth. Never on here has it dropped below 10%, well above inflation. And you can also see a much lower payout ratio over time. So look for this when you're looking for that growing dividend income. Next, we have reliability. And this is Visa. First off, they've had 15 consecutive years of growth. So they're still about 10 years away from dividend aristocrat status, but they're showing that they want to get there. You can also see that growth has been very healthy over the last 15 years, dropping below 15% just once. And another sign of that reliability is that yield never really creeps up one way or the other. It stays fairly flat over time. And then, of course, the free cash flow payout. Another very flat line, no spikes in one direction or the other. This is an example of consistency and reliability. And in 10 years, Visa will reach that dividend aristocrat status. This is what low reliability looks like. This is Walt Disney, ticker DIS. First, you can see just sort of that erratic growth. It grows, a big pop, and then suddenly they cut it again. It steadily grows, they cut it again before they finally cut it in 2021, and it's been cut for the last 3 years. However, they did just reinstate their dividend. You can see some other signs that led to that dividend cut. You can see that growth in free cash flow, and then suddenly it fell off a cliff. Granted, we had a COVID year in here, but it still decreased after COVID was pretty much done. Disney has a long way to go to turn things around, so we'll see what happens. But right now, this is a very unreliable dividend. Now let's look at an example of high yield. This is Verizon Communications, ticker VZ. The first indicator is seeing that yield jump up quickly over time. Their trailing 12 yield right now is at 6.6%, which is very high for any sort of stock. The yield rises as the dividend continues to rise. However, there's not a simultaneous increase in share price. And one sign of that is you can see that in the free cash flow versus how much actual dividend is paid out in cash. And you see that free cash flow, the blue bar, just hasn't really risen over time. So if you're not going to get that rising free cash flow, you're not going to get an increase in share price. There's just not money being made for the owners. Yet they keep increasing that dividend. So because of that, our yield is now quite high. And they also have a quite high free cash flow payout ratio. So this is what a few signs look like for a company that may cut its dividend in the future. I'm not saying they will, but they may. They also have very slow growth. All of it is very subpar, way under what inflation has been doing, especially the last 20 years. That is not the kind of growth that we want to see. Next, we have an example of what a very low dividend yield looks like. This is NVIDIA, ticker NVDA. Of course, NVIDIA has been the hottest stock in the market the last year. Their price has shot up and shows no signs of slowing down. Of course, that massive increase in share price without a simultaneous increase in dividend is going to lower that yield. They've kept their dividend flat the last 5 years, and that has resulted in the yield crashing down. It's almost difficult to consider NVIDIA even a dividend stock anymore. So you can see with that massive increase in free cash flow, and this dividends paid just has not even come close to rising along with that. So we'll see what NVIDIA can do in the near future. However, right now they are raking in the cash, and they probably see that they can use it better by reinvesting back into the business than paying out a dividend. And here's what dividend yield that's just right looks like. This is Chevron, ticker CVX. The signs here are they have that steady, reliable growth over 20 plus years now. That dividend growth itself has outpaced inflation. They have a nice dividend yield right now, trailing 12 at 4.07. And you can see over time that yield has been pretty flat. Nothing alarming on this chart. Now, one thing to point out is their free cash flow. It has been erratic, but that's, I think, due to the nature of the oil industry and how cyclical the prices are in that industry. One thing that these oil companies do very well, however, is when times are good, like right now for the oil industry, they do a good job of fortifying their balance sheet and stacking that cash so that they can continue paying that dividend when times are a little bit leaner. So in that way, Chevron does a very good job of maintaining that very healthy dividend yield. Next, we're going to look at the free cash flow payout. This is Tyson Foods, ticker TSN. First, you want to look at the averages, and you can see even going back 20 years, it's a negative free cash flow payout. And that's just because of this year's massive drop off to negative 363%. And you can see that right here in the free cash flow. Their free cash flow has fallen off a cliff, yet their dividend still continues to rise. They've had 10 years of consecutive growth. But due to that declining free cash flow growth, you've also seen that year-over-year growth decline and that yield go up. So this is an example of a lot of red flags. You have that plateauing growth, rising yield, the free cash flow payout has steadily risen and is now negative. So it wouldn't surprise me if Tyson Foods cuts their dividend in the near future. And last, we're going to look at Applied Materials, ticker AMAT. Applied Materials, you can see in the last 15 years, they've been paying out their dividend, that their free cash flow payout has decreased over time. Just last year, it was at 12.9%. And you can see that down here. As that free cash flow has risen, the total dividends they pay out in cash has stayed pretty steady. And while they've been able to increase their dividend on a per share basis, they have a lot of room to grow that dividend. You can see the free cash flow payout percentage has steadily declined over time. So while Applied Materials doesn't have a long history of growth, only 5 consecutive years of growth now, they do have a very long runway in the future. And all these charts indicate a very healthy and safe dividend, not only for reliable income, but very good growth in the future. Though just last year, they increased it by 16%. Their free cash flow per share far outpaces their dividend growth per share, again indicating a long runway for growth. These are some examples of how to visualize various dividend metrics. I think it's good to see it trending over time. At least to me, it helps me make more informed decisions. So just pay attention to these top dividend metrics and you'll always ensure the safety of your income. With that, thank you for watching today's video. And what do you think? I love the feedback, so please let me know in the comments below. Also, please hit that like button. And if you found this info useful, consider subscribing to the channel and joining our community. Thank you and happy investing.